So welcome again. Hope you are having a great Wednesday, or if you're watching on demand, any day you're on. So anyhow, please feel free to place your questions, comments in the chat. We like the interactivity. I will try to hit your questions as we go. If you are watching it on demand, still submit your questions, and I will absolutely answer them generally with a email or video reply, so you will still get good answers to your questions. So today we're going to focus on your company's 401k, how to empower, motivate your team, and strengthen your business, get your tax preferences. It's good for you, it's good for them, and it can be way more affordable than most people believe. So first and foremost, kind of here, remember our disclosures. We build all of our presentations custom, and generally, right up until the actual presentation, so that it will be timely and good. But we make no warranties or representations. Please double check and look things up again before you do them. Absolutely, if you have them, consult your financial advisor or investment professional, tax professional, attorney, CPA, etc. before taking any actions. Everything that we do like this, if you're not a client, is for informational and educational purposes only, and not to be considered advice. Okay, so let's look at our kind of bottom line up front. I always like to do these. Beyond just the things that people, I think, generally think about when they think about 401k plans, it's just, this thing where people can put money into and invest it in things. It's also another one of your benefits, right? And I think an important one, because we don't have the things that our parents and grandparents had, most people don't, where they're going to have a pension that they're going to be retired from and just be able to depend upon, or putting Social Security with that, and they don't need to worry about saving anything else. And so I think more and more you're going to see it in the news where people have not saved well. We're going to have more destitute older people, and it's just going to become more and more important that you as an employer or as a manager or HR professional or head has this important benefit that you can absolutely, tell these new people that you're trying to recruit, or you're making an increase to retain that management, because turnover is expensive, right? And if you have the best people working for you, you absolutely can have much better productivity, profit margins, etc. Not to mention the tax incentives that have always kind of been included in there, from getting a tax deduction to getting to grow tax deferred, or if people are using the Roth, the tax free. And we'll go over all these things, as well as some of the newer ones, to help especially smaller businesses set them up and defer the costs for the first few years, if not pretty much pay for it for you. And then, of course, just the financial wellness. And we'll hit this, kind of one of the last things I talk about, in terms of, if spent wisely, the money you put into financial wellness programs and absolutely having financial security and a secure retirement is a part of that. I think there's multiple studies, but one of them might have been from Harvard or what. So for people that are really affected by this, for every dollar invested can give back up to like $6, over time. And so it's a great investment beyond the other things that I mentioned. And nowadays, it's a lot more competitive on price. There's a lot more competition. The government's going to help you. It's super affordable. So again, throw your questions in if you got them. Always makes it more fun to answer as we go along as well. So throw them in there. And again, I will try to hit them. So why offer a retirement plan? We talked about this a little bit in the last slide, but look at that. 25% of Americans have no retirement savings at all. And I truly believe that employers make the biggest difference in this, if we're going to leave Social Security aside. And it's really the companies that have put good plans in place, that have that culture of having people participate and, kind of take that mentality of teach a man to fish instead of just give them things, to make them active participants in matching type programs, getting the right behaviors, building the plans to where they can't take the money early and they actually get the benefit of the tax deferred growth that we mentioned here. And I'm going to show you a couple examples of that coming up. in terms of the exponential power of growing your money, and then being able to couple that with the tax benefits like pre-tax or Roth, etc. And then, of course, the business tax benefits of being able to put stuff into a retirement plan, having it be tax deductible. Also, like we had said, now more of the front ones, especially for smaller companies, that it's harder to afford these things. The government helping you on that. And then again, employee satisfaction, increased productivity, engagement, etc. So, driving on, my slide will move. So then the other side of things, the risk of doing nothing. This is a really big one because I don't think a lot of people think about this. But, when you've had someone work for you for a long time and they do their job, and, there's no reason to let them go, and they're just hanging on because they can't retire. They can't afford to retire. Over time, again, we're not talking about anything discriminatory or whatso, but people can become less productive, or they're doing the minimum, to stay there. Plus, unfortunately, we don't have any universal health care or anything. So especially for medium and small size businesses, if you get an aging workforce on your health insurance, it becomes increasingly expensive, right? And so having people delay their retirements because you didn't provide a good way for them to be able to save and build up that money is actually not even a double-edged sword. It will come back to bite you and be very expensive if you plan on running your business well into the future, which I very much hope that you do. For them, financial stress. If people are worried about, what's going to happen to them, and they're always kind of living paycheck to paycheck, they're probably just not saving outside in their Roth IRA or what so. And so they're not going to be as productive when they're at work. They're not going to be as healthy, probably using more sick days, lower engagement because, they don't care about me. How much should I care about them and doing what they want, meeting the minimums instead of excelling? So again, you got to think about these things. Benefits just aren't pound for pound. How much does it cost in dollars on your HR expenses versus income or revenue sheet? And then a competitive disadvantage. I think more and more into the future, of course, we'll see some productivity increases from AI and robotics and, different things that come. But the best people are going to be the ones that we need. And I think there's going to be less per how many people want them. And so you need that competitive advantage of having good benefits and retirement plans that allow people to defer or get a tax deduction or save tax-free, that's built in a dynamic way that's almost gamified, is something that'll really set you apart. So when we think about this, one of the biggest advantages of a retirement plan are tax advantage savings. And I've been talking about it, hinting at it the whole time. But what are we talking about? So pre-tax means if we're talking about the employee, when they put it in, they're going to get a tax deduction. And then it gets to grow tax deferred the entire time. And then when they take it out, they'll pay taxes on it at whatever income tax rate is there at that point. If they save Roth, then they have tax withheld now at whatever their tax rate is now, or pay it at that rate. And then in the future, whatever that tax deferred grew to, as long as they wait until after 59 and a half and have had it in there for at least 5 years, they get to keep all that growth tax free. Okay. And so it really helps them to reduce current or future tax burdens. And then along the way, beyond getting the tax deduction now or the tax free later, they get all that in between tax deferred right there. And then, of course, you make it convenient for them to automatically save before it hits their paychecks. And let's be honest, for the vast majority of people, that is the biggest stumbling block, because most Americans live paycheck to paycheck. And if we don't get it out before and put it in an account that they can't really get to, then they're going to spend it. They're not going to save it, much less get the tax preferences. And so that power of compounding, of saving early, kind of almost mandatorily, and then not being able to get to it, lets them realize this compounding power of money which I'm going to give you a couple examples right after this. Now, on the employer side of things, it says all employer contributions are tax deductible. Recently, they made it available in the Secure 2.0 to allow employer Roth contributions. Don't see a lot of plans with that right now because it is tougher in terms of doing that and then the taxes coming due for the employees. I would like to see a lot of this more because if you really think about it, especially on the lower 50% income earners in the United States, a lot of them, besides payroll taxes, which you're not getting out of, are paying little to no federal income tax. Why would they need a tax deduction? They need to be saving Roth. And so if we can as employers set that up for them, even though it's going to be a rocky road, put money in for them that they have to pay taxes on, but they don't get it. But it's going to be so good for them in the future when they have that tax-free amount. So it is possible. It's a little trickier. So we don't need to tackle that right now, but it is possible now when to throw it in there that it was. And then, of course, the tax credits I'll get to later on that are available for setting up the plans, I think is really a powerful incentive for someone that doesn't have one. You need to get on it. I mean, there's almost no reason. Your first 3 years for most small businesses are going to be free. And then you get the tax preferences from being able to save way over an IRA or Roth IRA if you were even allowed to do it based on the income limits. And then we already talked about these, the in-house recruitment and retention power. And I was hitting at this, the owners maximizing their own retirement savings and getting all those breaks. So I did want to show you, just to get an idea. And so this just says, hey, somebody that's going to save for 25 years, you can see here, let's say they get an 8% rate of return. Most investors don't. But again, you set up a good plan that has a good advisor, or they're using these target date funds that they're not going to mess around, or the default investment options. It is absolutely possible to get that. And let's just say they're saving $250 a month, right? If we look at over that time period of them saving that, they will have saved $75,000. That's not chump change for most of your workers. But you look at that total balance at that point, it'd be $227,000. So the vast majority of that account balance now is growth. It's not what they put in. And then if they get that tax deferred growth and get to take it out tax free, that's all their money. They don't have to pay tax on that entire green thing if we could get most of that in their Roth for them. So I just like people to see, I mean, this just totally shows you the benefit of the compounding power of money. So starting earlier, if you get them in, to a retirement plan where you auto enroll them, automatically put them in a good investment option, set it to a certain percent, set your matches or whatever to where it incentivizes them to keep it at that rate. And then there's even a newer thing where you can do auto escalation to where each year it goes up by 1% until they hit a certain percent. Now they may turn it back down. It's a free country, right? So they can always change it. But just doing these little things that behaviorally nudge people, you can get them in the right direction, get them saving their own money, as well as you doing some matches and stuff. This one right here really just kind of shows what's the difference. Let's turn this down to something more reasonable. I was just playing with it earlier. Let's say people are paying 20% now, and it's 20% tax in the future. And so you can see, if you just save that money and you got the compounding power of saving about the same amount of money for the same amount of time for the same rate of return, and it's not a retirement plan, they're going to save up about $197,000 if their taxes are effectively right at 20%. And you see, if they take a pre-tax deduction and then pay taxes on it later, the after-tax amount they have versus Roth is actually the same. Okay. Where it really makes a difference is if we say, hey, someone's in a higher tax bracket right now, and when they retire, they'll be lower. So then you can see the pre-tax works out better than the tax-free. But let's be honest, with all the deficit spending, debt, where a lot of Americans are today, let's say your regular employee is probably making 15. With all the debt and deficit, maybe as a retiree, they're going to end up having to pay 25%. You see the difference there now is pretty significant, right? It's over 10% more with the same amount of savings. If and most of your employees will do this, they're going to save $200 a month. They're going to save $200 a month whether they put it in Roth or not. This little checkbox is just saying that it would put the extra tax savings in the pre-tax one. But most regular workers, they're going to put in the same amount. And so if they did that and they did it Roth, you could see what they're missing out here. I mean, this is like $60,000 of extra money, after taxes, on 250,000. So you're talking like 20% some more money if you build the plan right and teach people at least the basics of saving correctly, for where they're at. I mean, you look at, a lot of employees now, they're not paying much besides the payroll tax, and this isn't going to change anything there. You look at this, and it's huge. I don't know if that refreshed or not. All right. But anyhow, you get the idea. This is a very important benefit, and really stacking it together is a win-win for the employee and the employer. Okay, so again, throw your questions in if you got them. Let me know them, and I'll try to answer them for you. Let's compare some employer retirement plans, and it kind of gets more complicated the farther I go into these. But I'm not going to give you a super deep dive into it, but you're definitely going to kind of understand, the environment out here that you have. So we have simple IRAs, which are simplified retirement plans for businesses with fewer than 100 people that really don't want to put anything fancy in there. You're not worried about the maximums you can put in, etc. But you want really low admin costs, low to none, and you're willing to, take the lower tax preferences, have less flexibility, etc. And then the SEP IRA, a simplified employee pension IRA, any business can pretty much have these, but we'll go over it. It's mainly for employer-owned, sole-run businesses, or maybe you have your spouse inside of there, because it only has employer contributions, and whatever you want to put in for yourself to a certain degree, you have to put in for all your employees. So it does not tend to be an economical choice for an employer when you have lots of employees. But if you're doing your own thing, it absolutely can be a good low-cost option. 401ks, kind of the mainstay now of the corporate world of what people are doing for retirement savings. These are all, except for the last one, it's kind of hybrid. These are all what's called defined contribution. So defined contribution, or what we're used to these days, where there's an account that you and the employees put money into, and then based on the rate of return they get from the investments it goes into, then it grows, and at the end they have this big pot of money that they can take how they want to accomplish their goals, usually a retirement income over their lifetime. Then cash balance, like I said, is kind of a hybrid, but the hybrid to what? So defined benefit is going to be like your state teachers' retirement, public employees, Social Security, things where you put money into. You don't generally get any of the balance. You just put an application in when you're eligible to claim benefits, and then they pay you out an income for the rest of your life. Cash balance is a pension that's also how much you can put into it based on actuarial calculations, but it does go into an investment account, generally that the employer controls, not the employee. And then at the end of it, then it pays out the balance, or you could annuitize it. Depends on the plan rules, but most people roll it into an IRA or into their 401k and just combine the things. So we're going to talk about these a little bit so you understand a little bit more. I just wanted to give you the overview of what we're talking about here. So it says, I got a question. And so the question is, what is the best retirement plan if I'm currently a sole proprietor? What if I may end up with employees down the road? So it really depends on what you want to do, because one that I didn't talk about in there is an individual 401k. And so for most solo kind of business people, then you're going to be either doing a SEP IRA or an individual 401k. Okay. If you're going to end up with employees down the road, you're probably still going to do one of those things. And then you're probably going to change your plan from that to either a simple IRA or a regular 401k, depending on what your business is, what you believe, what you want, etc. Okay. And so I'll these a little bit more, but that's kind of my short answer for that, and you will understand more as I talk through these things. So, a simple IRA, not as many people do these anymore because they are limiting, and there's a whole lot less providers that provide them. Okay, and so they are very simple, though. They generally, the only thing to do is an employer match of 3%. So if the employee contributes, you match up to 3%, or you just do a default. It says non-elective, so you just give everyone 2%, regardless of whether they contribute or not. So it's up to you. Generally, when you work with somebody, these plans will usually, some advisor will help you set them up. And when you're working through it, you'll decide which one's best for your business based on what you want to incentivize and your demographics, et cetera. Most employers that are setting these up are really trying to keep their costs down. So they're just looking at these both ways to see what costs them the less in terms of having to contribute for the employees. Okay. You have lower contribution limits. I've got a little graph that shows you both so that you can see. And then easier in administration, but fewer plan features. We already talked about that. And you and the employee can both contribute to them. Okay. With SEP IRAs, only employers contribute, and it's up to 25% of compensation until you hit the max. And so the max now is 70,000 actually. Okay. Or 77. Well, for these, I think it's just 70,000. We'll get to the 401k goes up to 77.5 with the catch up, but there is no employee contribution on this. So that's showing the 24, but the 25 is 70. And then it's very easy to administer. There's not a lot of paperwork. It's just like setting up a regular account. But really, as I mentioned, its Achilles heel is if you have other employees and you really want to use this to get a decent amount of money in for yourself as the business owner, it's just not very economical to put that much money in for them too. I mean, it's great. You'd be like a hero, but most people aren't going to do that. And then no loan features available, et cetera. So if we look at like 401k versus simple, then we can kind of see the differences here. So you can kind of see the max is 16,000 versus 23, and then the catch-ups are smaller as well too. Is there a Roth option? Yes. There never used to be a Roth option for simples, and it was a real, again, kind of handicap for it. But since 2024, they added that into there. So it is available now. Can't do loans. Again, it's a very streamlined, simple thing. There are the ability to do loans with 401ks. I'm kind of against them and hardship withdrawals on 401ks. I know it sounds kind of mean, but there's a lot of your employees that'll always get themselves into financial troubles. And so not letting them be able to rob this kitty is good for them. And even if they go into bankruptcy, generally there's no way for creditors to access this unless the participant takes it out themselves, right? And so if you don't give them the ability to take it out until they're already ready for retirement, then that money's going to be there for them when they get there. Vesting options. Vesting means for the money that you put in as the employer, can I say that a certain part of it, I mean, there's different rules for different types of contributions, but a certain part of it is not eligible for the employee to keep if they don't stay with me as an employee for a certain period of time. And you have flexibility with that with the 401k, which gives you a little bit of a golden handcuff, to keep people around versus just hopping jobs. When you've invested in them, well, then you can claw back some of the employer contributions. Simple IRA, nope. It's just immediate vesting only. When it goes per these simple rules, whatever's in there when they leave is theirs. Okay. And there are ability, like I said, to do the auto enrollment, auto escalation, but not in the simple IRA. It's a little bit more complex to manage and to keep up, to do the annual work, a lot simpler with the simple IRA. And then scalability, as we said, you can only do it for a certain amount of employees. And there's really no customization for different groups or anything like that. And so, but with 401ks, absolutely. Okay. But some of the reason people don't like to do them is because it costs a little bit more to get all the professionals you need to be able to do all those things and to prove to the government that when you're using all those extra features, that you're not discriminating and following the Department of Labor rules and the IRS limitations, et cetera. So let's dig a little bit more into 401ks because that's what this is about. But I did want you to see kind of the landscape of some of the other things. We'll get to the profit sharing and the cash balance pension, but these are generally things that people layer on top of the 401k. So knowing the 401k basics first is kind of the most important part before we get into the more complex things that you could layer on down the road, or if you're already more successful now. Okay, so let's look at this. And again, if you got questions, throw them in. Happy to answer as we go. So first of all, I've been saying a lot of these things, and now we're going to define them a little bit more. So there's employee contributions. Okay, it sounds pretty simple. People can put money into their own 401k, right? But there are different ways they can do this. So for employees, they basically have like 3 different types of contributions. And you could count as a fourth with rollovers, okay? But the first one we talked about is pre-tax, right? So they can put money in and take a tax deduction, and we put it in a bucket that labels it so that later on when they take it out, the government knows that they owe them tax on it, right? They can do Roth contributions. So when you withhold it, you're still going to remit the tax to the government. And then it's going to be put into a Roth tax-free bucket so that later in the future, when they withdraw from it, the government will know it's tax-free, right? Because we followed all the rules, documented it, et cetera, based on how the employee put it in there. Then there's another contribution, which some people more and more often are taking advantage of, called after tax. So after tax is kind of, if you've ever heard of doing a non-deductible IRA contribution or the backdoor Roth IRA, it's putting money in without taking a tax deduction, but you're not putting it in Roth. So it's an after-tax contribution, and the money gets to grow tax deferred. And then all the growth, the easy way you could think about it is all the growth kind of goes in with your pre-tax bucket, and then your principal that you put into there is after tax, right? So if you ended up putting, $100,000 in over, the last 10 years from when you're 55 to 65 after tax, then you could withdraw that $10,000 back tax-free, but say it grew into 25, that extra 15 would be, with that pre-tax bucket that you would owe taxes on, right? But you could still get more money into the 401k than you could by the limitations of the regular pre-tax and Roth. So again, I'm not trying to make this too complicated. I just want you to understand that there's different contributions. And then I said the fourth that could be considered employee contribution is a lot of plans accept rollover. So employees could roll over their old plans into your plan or whatso, and that money would be kept separate as a different kind of contribution type than the salary kind of reduction contribution type. Then we get into the employer contributions. So it should say employer contributions. And so employer match is absolutely one of those, so you could say, well, if you put in 5%, I will match it 1% for 1% all the way up to 5. One of the things we will talk about is safe harbor. And a lot of people will put safe harbor on their plans because it lets them out of having to do some of the complex testing for discrimination and whatso. And some providers will give you discounts for that. I don't know. I found it kind of offsets each other between having to make extra contributions to meet the safe harbor versus the money you save by it being safe harbor. So I wouldn't let it make your decision. I lean more towards safe harbor because it just makes it easier and safer, et cetera, that if you just do that well, then you can do some of the things that we're talking about with profit sharing with less worry because that safe harbor is met. And so the safe harbor is kind of like I was explaining to you with the simple IRA, except it's about 1% higher. So if you can do a match, you do a match up to 4%, or you do a non-elective up to 3%. And so you'll see that usually you'll have safe harbor contribution, employer match. And so for a lot of plans, I like to incentivize if people aren't opposed to it. And you won't have a ton of employees that take you up on it, but to do some kind of percent match up to 15%. because I really believe that most Americans are behind the curve. They need to be saving 15% in addition to what you and Social Security do, to really be on a solid track. And so even if you did something like 0.25% match to 15%, right? And that would be 0.25% over. So most people will make the employee put in 6% to get 4%, and that would be the safe harbor. And then from 7 to 15, right? Then maybe you do that 0.25% match. It's only like 2.5% more. It costs money if people take you up on it. But like I said, not many people are saving that high, but it's where they should be. So your match incentivizes them for a fraction of what they're going to put in to get there and to do well. So employer match. And then in addition to that, then there can be the other contribution types that we'll get into, like profit sharing and what so. Those all come from the employer. And then, of course, the bread and butter of how retirement accounts work is investment growth, right? Because we don't want to just put it in there and it just sits there. It needs to grow. And ideally, we don't want like a savings account or a CD rate. We want to get like some actual growth, get it pumped up to 5 to 12%. But really, what you're after is plus inflation, right? So inflation is 3%. And we only had, like, say we had a really short-term type CD rate the last 20 years, and it was like, 2%, then the money's not growing faster than things are getting more expensive. It's not really growing, right? And so the ideal is to get a few percent over inflation, depending on the person or participant's risk tolerance, to make sure they don't freak out and behaviorally because their account goes down. They mess it up by selling during a downturn or what's it. So again, that's kind of more where you get an advisor, and we'll talk about that a little bit later to help with some of the behavioral things. So again, limits, as we had talked about before, I'm not going to hit them again. If you allow it in your plan, then generally withdrawals before 59.5 will incur tax penalties. There are exceptions to this. Again, I'm not going to hit all of that. That's kind of more for a participant, like kind of retirement 401k planning, rather than us talking about 401ks for businesses. And so, as we talked about before, the power of compounding is by far, one of the greatest things out there. You can see Einstein's quotes and Warren Buffett's, et cetera, and then you get to double it up with the tax advantage nature of it, which we showed over here. So you can kind of see, again, just for reference, how much of it is growth versus how much of it is principal. I mean, you get a really young person in here and get them to save and have 40 years, you can really, exponential is when you actually see this growth is not a linear growth that just keeps going sideways. You see where my mouse cursor is, it's going this way. At a certain point, it hits an elbow and starts going up exponentially there. Now, what ends up happening is someone retires, and instead of this curve continuing to go up, they start taking money from it and it starts going sideways, right? A lot of people that didn't save well, they'll start taking it out and it starts going down. And then that's where that fear of running out of money comes from. But with 40 years, you can see here, it's 120 saved, 685,000 in actual return. So time is your employees, your greatest ally in there. And then the tax benefits just amplify that in terms of how much you have when we spread it out to a longer time period, right? And so you can see here, it's a whole, 100,000. Let's get this back to reasonable difference here of the pre-tax versus the Roth, versus if they just took that money and saved it outside of you having a retirement plan. Look at that benefit, almost double. That's crazy. Okay. All right. And then, you got to get consistent contributions, like getting them auto enrolled at the right percent, getting it to auto increase, sometimes getting an advisor or a firm to come in there and doing employee education. People will get off track sometime. They're not allowed to grab the money when something bad happens. They're like, turn my contributions off. I got to save every dollar I can. You know what? It's real easy to do that and turn it off because you're motivated to need money. But once that period's passed, most of them forget to turn it back on. And so getting an advisor, somebody to kind of intervene in there and be like, come on, man, you're at 0%. You're not even getting the safe harbor match inside of here, not to mention any of this other stuff, plus the compounding power money, plus, the tax-free growth of your Roth contributions. What are you doing? They're like, you're right. Let me put in 4%. It's like, you got to do at least 6 to get the whole. All right, I'll do 6. I'm telling you, these things make a huge difference to people actually having these accounts full of money that primarily, if done right, is mainly them putting in their own money for themselves. Okay. So plan design basics. We're going to talk about this. There are a lot of more complicated things you can put in a plan, but you don't have to be complicated. And sometimes you keep it simple, stupid, right? The old KISS thing. But let's look at the simple plan design here. So eligibility period is how long until you're going to let them into the plan. Okay, so you can go up to a year before you let them in, or you can do immediate, right? Now, why would you pick one versus the other? Obviously, if most of the people, you do a good job sorting people out, most of your hires are good, you don't waste a lot of time with it, you want to have really competitive benefits, you tell them how awesome your retirement plan is, and you know what? First day you start, we're going to get you enrolled, you're going, people are like, oh, that's awesome. Then you come to some other employer and like, well, after you work a whole year, then you can be in the retirement plan. People are like, oh, dang, that sucks. But sometimes waiting periods can be good, especially if you have a high turnover. Okay, so if you have a business where you're just like, dang, after people have been here for 3 months or 6 months, sometimes it's a year, they're probably going to stay here and I want to reward them. So maybe you build your plan a little sweeter with the match or profit sharing contribution, but you make people wait longer to get into it so that you don't have to give money to the people that are just going to turn over and not be long term. So you got to, weigh the difference of what works better for you. But again, I would say still trying to do, what's right for your employees that works for you as well. The match formula, we already talked about this a lot in terms of the safe harbor or how much you're going to match. That's not safe harbor. You could do the 3% guaranteed and then match them, 0.25% all the way up to 10%. There are lots of different ways you could do this depending on how you like it. I kind of mentioned the one to you that I like, and that's actually how our 401k is set up. Vesting schedule. So for any money that you put in besides the safe harbor, you can set your vesting schedule, and there's certain ones. There's like different ones that are like okay with like the Department of Labor, so you can't do anything you want to, but you can go from immediate up to a 6-year graded schedule. So you could say, you're 0% invested until you've been here a year, and then it's 20% per year, right? You can do a 5-year cliff or a 3-year cliff. It's like anything I put in for you besides the safe harbor, if you're not here for 3 years, I'm taking it back, So you can make a vesting schedule, which is all fair and good as long as you follow the rules, which someone like us as an advisor or a TPA, which is a third-party administrator we'll talk about in a little bit, will help you get right and make sure you follow the rules well and understand, because there are DIY ways to set these things up, but then there's so many things you have to pick that most people don't know what to pick. And in a lot of the templatey things, they just have prototype plan forms that just stamp you into a bunch of these, which later on, when you want to do something or your employee does, it's important. They're like, sorry, that's not a part of the plan. And you're like, well, I'll change the plan. And they're like, well, we can amend your plan and do all this, and it's going to be this many thousands of dollars, and it's only effective after this date. And you might have missed the important thing that you needed to do. And it's not done well. Okay. But that can be cost effective. Contribution types, we already talked about these. But you can allow or disallow certain of them. There are certain things that have to be allowed, but there are options for you to say, I don't want to do after-tax contributions. It's just too complicated to keep track of, and I don't want to deal with it. Or someone like, we need that because they can do that at this other state hospital, the physicians I'm trying to recruit or whatever the case. And so we need to have that too and do this mega backdoor Roth for the 401k. And then, of course, you got to include the features like loans and hardship withdrawals and other different plan provisions that you can put into there. So you got to figure out all this stuff, okay? And you're generally going to have a couple different people to help you. So the safe harbor, I kind of explained it already, but here it is, just kind of laid out for you. Safe harbor, like I said, allows you to pass automatically some of the complicated non-discrimination testing. Okay, it's called ADP and ACP tests. Your TPA will generally do it for you. If it's safe harbor, a lot of times they'll give you a little bit better deal on how much they charge to do it, but you may have to contribute a little bit more than you would have otherwise. And sometimes when you're setting up the plan, the TPA is going to be able to help us figure out, how much more expensive a safe harbor would be than a non-safe harbor, depending on how much the testing would cost and how much based on how many highly compensated and owner employees you have versus non-highly compensated. If you just got a lot of, blue collar or lower, and only you and one other person are highly compensated, then maybe you don't need a safe harbor. But and you don't need to put in a lot for yourself as like an employer contribution, and then you might be able to save a couple $3,000 without doing the safe harbor. But if you do have highly compensated, you need to put in a lot for yourself, where it's competitive for some of your upper sales workers or executives, then more than likely the safe harbor will pay for itself by allowing you to do those things, because you already, according to the government standards, made a good minimum contribution for all the rank and file. Okay, so that's, if I was going to simplify that, that's what this is for, is to make sure that everybody, especially those, in the middle and the bottom, are getting a good, base amount from the employer, so they're less worried about doing more for yourself and your highly comped employees than everybody else in the business. So like, hey, we're giving you these tax preferences. You got to minimally give to your employees. That's what the safe harbor is. Okay. And so, like I said, 100% match on the first three, and then 50% match on the next two. So that's like, they put in 1%, you put in 1%. They put in 2%, you put in 2%. They put in 3%, you put in 3%. They put in 4%, you put in 3.5. They put in 5%, then you put in 4. And so again, as they get to 6, then you're going to get to 4. Okay. And that's how that works. And non-elective, you could just straight up put 3%. So most of the people contribute into the plan, then you just put in 3% to everyone. And it's cheaper than if more people put in enough to get the safe harbor and you had to put in 4. Okay, so this one just ends up being simple. Some people will also elect it just because they don't have a lot of people that contribute, and they want people to have stuff in their retirement plan. That's a more kind of altruistic application of the non-elective in there. And then we talk about the key benefits of being able to put in more for highly comped employees, reduces the administrative complexity of having to do all the testing. It makes it predictable exactly how much you're going to have to put into there. And then some, kind of safety with automatic compliance in one cell. Talking about some of the auto things we talked about before. So auto enrollment just basically says, you could say after 30 days, they're automatically enrolled in the 401k at 5%. You can do that. Okay. And you could say, I personally like to do that in Roth. Automatically enrolled in Roth contributions at 5%. Okay. And that can increase, the average participation rate from, half or less all the way up to pushing towards everybody, right? Now they could go in there immediately when you auto enroll them and take themselves out. But people selecting out versus selecting in, you've probably seen those studies or the statistics of countries that have auto enrollment from organ donors versus not, right? It's a huge gap like this, right? And then for something like this that really helps your employees, that is a huge improvement. Auto escalation, so increasing the employee's contribution, usually each year, 1%. Okay, so if you auto enrolled them at 5% in Roth, they just didn't even pay attention to it. It just happened. They save that, then the next year it's just going to go up to 6. Most people, they're not even going to pay attention to it, especially if they got a COLA or something. So you gave them the 4% COLA, and then you take the 1% from it. then they're still going to see their raise and not even do the math to realize that they're missing that 1%. So they can get all the way up to saving 10% per year a lot of times till they notice it. And by the time that they notice it and they see how big their account is, they're like, dang, that's a lot of money is coming out of my paycheck to go in there. But heck, I like the statement that I got. So it's kind of like something that happened to them, but then I think they kind of internalize it, but like, hey, I did a good job, and they continue it. Okay. So it's a little big brotherish, but it really does make a difference in helping people actually have some retirement savings. QDIA, almost all these plans have them now. It's a qualified default investment alternative. It's like, let us pick a good investment option for you in there that's balanced. It's got your eggs in different baskets. The target date funds, those are, you've probably seen them. It's like 2040, 2035, 2050. And the farther out it is, generally the more aggressive it is. And then as they get closer, it gets more conservative. So that's a good base QDIA. Obviously, there's good and bad target date funds out there. We like to build our own QDIAs for our clients and their participants. Most of our plans use them. But again, if you're going to do something where the advisor or the firm that's the investment side of it isn't going to like take care of participants or the plan, a target date is a great default option. But again, consult with, the 401k professionals, advisor, et cetera, to make sure that what you're doing is right for your firm. So digging into some of what I said that we would get into when you're starting to do more complex, most people that have a decently profitable business that's not too sprawling big, and I've seen, a lot of the biggest companies out there have profit sharing plans as well, is almost like an addition onto the 401k that lets the employer make contributions that are absolutely voluntary, okay, to the participants that generally have, it can, depending on the formula but generally have nothing to do with how much the participants are putting in. And this gives you a little bit more flexibility to have different groups of people inside of there that you give more or less to in these profit sharing contributions. And so this is, again, for designing your plan for like recruiting and talent acquisition and keeping people around and have investing on it. This is where you can really kind of make it shine. And if you're really smaller, where it's owner and just a few employees, you can really get it kind of top heavy. You got to follow all the non-discrimination testing and make sure you're doing it right. But generally you can get, if it's small like that, to where it's like 80 to 90% into the owner's account and the other 15% in employees. And I know if you're listening to this and your employer like, that's not fair. Well, the way that the IRS Department of Labor sees it is that most plans are, and especially if you're already doing the safe harbor and they're getting that kind of match into there, that employer contributions, then what they're saying is, all right, we will let, the top higher compensated owner people have a bigger proportion of this profit sharing contribution, as long as they still give the employees more, which most companies don't give, right? So they will let you give a little bit more, not as fair and balanced, because you're giving more than just about anybody does, right? And so it's an incentive for owners and companies to even make this extra profit sharing contribution, and therefore you're allowed to do that. But there are allocation formulas, and you got to pick. This is where we really get into, do you have a good advisor in TPA for, which one you pick and how it's allocated and how you make your employee groups, et cetera. It's like it says, it can be designed to favor older or higher paid employees, or, you can have a cross-tested plan. There are all kinds of different ways to do it, but you got to be careful that you do it right, and that it's calculated as well. Generally, these get made at the beginning of the year for last year. Okay, so it's kind of after the fact. You got all the way up until tax time to be able to put the profit sharing in for last year, so that we can actually calculate, what was the profitability of the company. Do we have enough funds to be able to make this contribution? How much is it going to be? Who gets what, right? Then cash balance plans are even a step up from that. And it allows us to go over kind of that, 70,000 so limit. And it very much is based on age and income, okay, and how much you put in the past on stuff like this. So, this you generally need an actuary. Some TPAs have actuaries. A lot of times you have to hire a TPA and an actuary to go together to make the calculations, and then it can go as high. I've never really seen it for an individual go to 300,000, but it can go into the 200 and some thousands for an individual. So again, if you have a highly controlled smaller business, this can be super powerful, especially if there's some kind of owner buyout going on to where the one senior partner is getting paid out a bunch. This can really take taxes down. But generally, you need to do this for at least a minimum of 2 to 3 years. They don't like people to spin up the plan for a year and then spin it back down. So, I would say if you really want to do this, you do it for 3 years. You're going to incur, somewhere between $3,000 to $10,000 extra admin expense to do it. But you can see if you're in some of the higher tax or income earning tax bracket times of your life at the end of your career or whatever, then this can be a really attractive solution to be able to be one of the biggest tax deductions you have, especially with some of the things that you can lose, like the QBI deduction and stuff if you're a certain type of professional business. The 199A, again, I don't want to get too complicated, but if you know these terms, this could be a good thing for you. If you're running a private doctor type practice like plastic surgery or something like this, having this type of thing can help you compete with the bigger players out there and the state institutions that are running medical centers like Texas and Ohio State and Cleveland Clinic and different things, to have a nice pension to go along with your 401k that you do profit sharing. You can really get the retirement benefits up to better than sometimes what a lot of those institutions are doing. So it's going to be a huge competitive advantage for getting and keeping talent that is high income producing, and they make a lot. And some of those retirement benefits are very important from those institutions that have the state pensions and stuff like that. Okay. So plan layering. So if you want a base plan because you want to have something for your employees, and we don't want to make it fancy, we're not going to add, we're going to try to keep the cost totally down for the employer. There are just total base plans. Now, these are really close. I'd say more people will do this than will do this, but there is situations where economically this can work better. But a lot of times there's not much difference in costs, as I had mentioned at the beginning. And so we see a lot of this of doing the 401k plus the safe harbor when people get decently profitable, since this is absolutely optional. We'll see. I keep having some of them doing the 24, but it's 70,000. Then do the 401k safe harbor with a profit sharing. I mean, you can do a 401k with just the profit sharing without the safe harbor. But again, a lot of times when they're calculating the profit sharing, if you actually make it, then about what would have gotten calculated here is going to get calculated to what the employee's got to get for you to be able to maximize it. And then you really want to go creme de la creme, then 401k plus the profit sharing plus the cash balance, and you're going to get your highest comped owner type employees, somewhere between $100,000 to $300,000 a year in total contributions, mainly pre-tax. But again, if you're making that much money, a tax deduction is probably a welcome thing to get, right? So I kind of already went over this. I'm running out of time. Throw your questions in. I still haven't seen any. Hopefully that just means I'm doing an excellent job of explaining everything to you. But I like doing the safe harbor as like an ideal kind of 401k plan setup. And this is just, I want to give you an idea. I don't want anybody to just say, this is the ideal way to do it. No, every person and company is different. You have to look at all the options to make sure what is right for you. But I like this, doing the safe harbor with a 401k, auto enroll people at 6% with that 4% match. So they're automatically getting that full, safe harbor match. You can talk to them, say, hey, you really should be at 10 or 15%. Maybe they'll turn it up themselves. But again, it's kind of hard to put people at higher than 6 or 8% without their permission, because they may really need their paycheck. And if you go up too high, you're just going to get them to go in and turn it down lower than what they might have just tolerated and left it at. And then turn that auto escalation on, maybe turn it off to 10%. Have a really good QDIA. Keep up watching that, because when businesses have these, that's where all the money tends to congregate. And so we got to make sure that whatever default investment you put into there, it's not only good when you put it into there, but we keep checking it to make sure that it continues to be good in terms of cost and performance and what the management is, or if it's changed since you set it up. And then for most businesses, unless you really have that high turnover, just start with immediate or 30 days, right? Because 30 days is not horrible, because that's about how long it takes people to get all their stuff figured out and get their benefits anyways. And it doesn't seem like that long to wait if you have to have one. But if you got that turnover and your employees are like, yeah, that makes sense, man. Like half the people don't work out. They think that it's great, and then they just like milk off of us, and it takes us a while to weed out the bad apples. Then yeah, do 6 to 12 months. If the rest of your employees are like, yeah, that's cool. But then you may want to have some extra sweeter thing to where you do an extra 2% over the 4%, but you don't have to give it to the people in the first 6 to 1 year. So then you'd kind of sell that to them. And it's like, hey, you get more, but we're going to like not let all the people that fell out in the first year get it. And people are like, yeah, I get that. That's cool. I understand. So then you still get that benefit of the employee buy-in and hopefully better productivity, because you made this awesome benefit for them. Okay. Optional benefits. We talked about this before. I'm not a big fan of loans and hardship withdrawals because it just lets people rob the kitty before what it's supposed to be for their retirement. And so I would recommend in most of these plans to just not allow them. A lot of times I will see plan loans in there, primarily because the owner, if they had this conversation with someone like me, primarily because the owner wants or needs to take a loan. I've set up lots of plans where we take these things out and then eventually we amend it to allow loans because the owner needed to take a loan. So anyhow, that's kind of my 2 cents on that. We could talk about it or talk about it with your professional about the pros and cons of that. I personally like big brothering people on this, because regardless of how they feel about it right now, like later down the road, they'll be really thankful that they have, this huge compounded amount of money because the rules and the guardrails were on there, the bumper rails at the bowling alley, right? In-plan Roth conversions. It's a no-brainer to me to allow people to do this, try to negotiate a lower cost for it. That allows people to take the pre-tax and turn it into Roth if they have a low tax year or whatever the case. And that mega backdoor Roth lets people put in after tax and then make a Roth conversion of the after tax over to Roth. Can be a big benefit for your more highly compensated employees, but not the top, kind of like the middle top tends to be a really good feature, especially for people that are getting closer to retirement. At least these days, things can change over time. Who's a part of your plan? You got kind of your accountant. That's what we were talking about, the TPA. You are very important. You can't delegate all your stuff. You have the ultimate fiduciary responsibility to do right for all the participants. You have the record keeper that like keeps everybody's accounts, and because usually all the money goes into one custodian like Schwab or Matrix or Mid-Atlantic or something like that, and then the record keeper keeps whose money is what and what type of, did it be a participant Roth or pre-tax or employer or rollover, like what types of contributions. The TPA does all the paperwork for you and the filings and everything. And then a lot of plans have an advisor like us that help keep track of everyone for you, talk to you about things, help you make decisions, etc. So I know I'm out of time. I'm just about done here. Jump off if you have to. But fiduciaries, when you're doing something like this, it's very important to really understand that you're a fiduciary. You're the main fiduciary if you're the owner or the plan sponsor. And so you are that named fiduciary. Plan sponsors usually are that. Some people will name a fiduciary, but that does not absolve you of your fiduciary responsibility. It's just somebody that's willing to put their butt on the line to like the highest legal standard with you. So it means that hopefully if you're going to delegate some stuff to them, that, if they mess it up, you're both in trouble, not just you. Okay, because a lot of these roles, like this 316, this is who does all the admin and files the forms to the Department of Labor and, et cetera. A lot of times people will do this role for you, like the TPA, but they are making you still be the fiduciary, the 316 administrator. So, this is required, but mostly it falls still to you as the plan sponsor. Then you can have an investment fiduciary. It's optional, and this 338 investment manager. And so it helps when someone's willing to do this. These are like the things that we do in terms of helping, make sure that the investment options are good inside of there, and picking the funds, doing due diligence, making sure the costs are good. Then the trustee is going to be whoever holds the assets for you, like the custodian, like we had said, like Schwab or Fidelity or Hewitt or something like that. Okay. And then this is optional again. You get a big plan that's hundreds of millions or billions of dollars. A lot of times there's a committee. So again, they're trying to set up this line of stuff to where it's not just one person or some people that are making money off the plan that are making the decisions, but then it can be other stakeholders like, someone on the executive staff or board of directors or head of HR, and then you make a committee out of these people, and make the decisions together, and it can show a lot more duty of care, and oversight and what so. This talks about what advisors can do to help you in terms of plan design, investment oversight, employee education, vendor coordination. So there's just a lot of work that we tend to do as advisors that if you kind of DIY, it's not going to be there. Okay. But, advisors a lot of times are not cheap. They're going to charge you probably somewhere between 0.1 and 1%. I would say the average on 401ks is probably pushing towards like 0.4%. Now, again, we're not talking about huge plans, but, medium to smaller plans where, you as operations manager, owner really appreciates the help of all this stuff inside of there. So again, I was going to deep dive a little bit more into profit sharing and cash balance, but I think I talked about a lot of that when we were there and thinking about how much you could get into there. This is just kind of a quick example, of how much could get into there for, say you're a 60-year-old business owner, you have all this together, you could be putting over $200,000 into your retirement plan, as well as doing an awesome thing for your employees. Tax credits. I apologize, I went over a little bit on this one, but I got to hit these things. These are really important because you can get up to a $5,000 annual tax credit for that first 3 years, up to $15,000 for doing the plan. If you do the auto enrollment, you can get an extra $500 per year. Most of these plans that we'll set up for people that are, I'd say our average employer is probably only 15 or 20 employees, then this is absolutely going to cover 100% of the admin costs and everything, for those first 3 years. So it's almost like you get it for free besides the match that you do for your employees, but hopefully through all the benefits I was telling you, is going to pay for itself. That's obviously plan and employer dependent, as well as, especially if the employer wants to use the plan to get a lot in for themselves, how much those increased tax benefits are if you're using it even 1/4 to its max. So anyhow, it's very compelling to just get started, man. And if you do everything right, then get a free plan, almost free plan for the first 3 years, and have an awesome benefit. So, benefits, tax credits to offset the startup and admin for the first few years. All your contributions are tax deductible to the business, unless you decide you want to do Roth, which again, I don't hardly see anybody doing that right now, but it's still going to be deductible to you. The employees would just have to pay the tax on that. Reduced turnover, saves money in recruiting and training costs. Earlier employee retirement reduces your healthcare expenses because people are actually ready to retire when they hit those upper ages. More engaged, loyal employees. Hopefully, that increases your productivity, ability to attract and retain talent. And for you, the personal ability to be able to build wealth better through those maximized contributions and tax preferences and what's so. So if you want, schedule a free 30-minute assessment with us. We'd be happy to go over things, talk with you about how your business is structured, type of plan that we can help you set up. We have 3 different levels of kind of more like we'll do a lot of the grunt work for you, and it's closer to the DIY without a lot of employee engagement, all the way up to our kind of more goals where we will have individual employee meetings and stuff and try to influence behaviors a lot, as well as build you an awesome plan. Just let us know. More than happy to do that. I'm going to cut this one short. Usually I'll go into a little bit of a self pitch for us. There's our team. You can schedule an appointment anytime. Appreciate the one question out there. As always, we wish you the best. I hope this helped you out a lot. Apologize that I ran over a little bit of our time limit on this one, but really wanted to hit the end, the compelling thing to not only how good the 401ks are and how good you can build it for them and for you, but kind of the now opportunity to be able to almost do it for free with the tax credits and stuff if you do it correctly. So thanks so much. I hope you are having a great rest of your Wednesday, and hope to see you next time. Check us out soon on our website. We put all of our webinars up there, but I just was talking with Aaron back here that we got a whole new list of all the way some great ones that are coming up, and I planned it all the way out until February, so we'll have those up within the week. You can check them out, sign up early for them. I think you can do that thing online where you can sign up for all the future ones, and even if you can't make half of them, it'll send you the replay so that you can watch it afterwards. So that's it. Hope you have a great rest of the day. We'll see you next time. Bye-bye.